All right, from here on out, we're gonna focus on currency translation adjustments, taking the functional currency and translating it into the reporting currency. And we're gonna go through the income statement and the balance sheet and how to convert each particular item on both those financial statements, taking the functional currency from the financial statements and converting it into the reporting currency. So let's start with the income statement. So in this scenario, we have rent expense, we have ABC Company UK Limited, and the rent expense was £1,000 as of 12/31/22. What you can do in that situation, you have two options here. I'll give you what I did in practice, and then also I'll give you the other option you can do here. So for rent expense, if you have an accounting system that has foreign currency rates in them, what my experience is you took the average rate for the entire month and then converted it that way. So I would take £1,000, and then in this scenario, the average rate of GBP to USD, British pounds to US dollars, was 1.3. Now I made up these rates. Don't go to a website and say, hey, Patrick's got the wrong rates. I just made them up. I probably should have checked them, but I didn't. So this is just a fake example. So £1,000 of rent, I'm calculating an average pound to USD translation of 1.3. So when I translate my £1,000 of rent, it is 1,300 US dollars. And then that's using the average rate for the month. That's what I used in practice. However, you can use the spot rate, the date of that specific transaction. So both are okay. I just know in practice, we always used average. And this is going to apply to revenue and any type of expense. The income statement is fairly easy. You take your average rate in this scenario for the month and you convert it. So my £1,000 times 1.3, $1,300 of rent expense, would apply that to sales, would apply that to other expenses. That is what you do with the income statement. Now the balance sheet's got a couple nuances within it, so let's go over the balance sheet. So with the balance sheet, same scenario, you have the £1,000 of rent. Instead of the expense side of it, we're gonna look at the payable side. So you have a rent payable of £1,000. In this scenario, majority of balance sheet accounts, not all, we'll go through the exceptions, the majority of balance sheet accounts are gonna get translated at the spot rate or the current rate of that day. I'm gonna take my £1,000 rent payable times 1.35, the exchange rate of British pounds to USD on the date of 12/31/22, which is the date of my financials. And my rent payable is actually $1,350. Now, I don't know if you've noticed, we already have a discrepancy between the expense and the payable. And this is a perfect example of how a currency translation adjustment can occur, because you're translating different items from your financials at different rates. So you're always going to have a gain or loss scenario when you translate them, and that's where it ends up in other comprehensive income. So let's go through some exceptions, some nuances related to currency translation. One being in the equity section, capital contributions. These are going to stay at the historic rate of when the capital was contributed. So in this scenario, I have £1,000. I know it's going to be £1,000 throughout this, just as a heads up. £1,000 capital contribution from ABC US Holding Inc. to ABC Company UK Ltd. In that scenario, it was contributed on 12/31/21. The rate on that day was 1.2 pounds to US dollars. In that scenario, that £1,000 contribution is $1,200. The £1,000 times the 1.2. And you will never change that. No matter what the spot rate is of that date, you're gonna leave it at the historical contribution rate. Next on the list is retained earnings and dividends. These are gonna be a weird historical rolling average. That's kind of a strange concept, but hear me out. In this scenario, so retained earnings, this is the accumulation of net income from the time of the entity. So you're gonna have multiple years. And if we go back to the income statement, you could see that we're using an average rate for the month. So in practice, each month has its own average rate for the month that's converting the income statement in. So your net income is going to be this combination of 12 months of average rates, and that is going to be in the equity section once you roll your net income into retained earnings. So each year you have this like blended average rate of net income, and you're just accumulating that over time. So this is where you end up with a historical rolling average. And when you convert the balance sheet, you're going to leave it at that historical rolling average.